Thank you, Roy. Uh, Welcome to our seminar on the bear put spreads. I want to take some of you just very quickly through a quick review of where to locate all the materials. If you are a bit ahead, if you just need to catch up, be sure to check our reference materials section where you will find option sheets, demo videos. We've just added a number very recently to our demo video list. And also, please be sure to check the strategy gallery where there's a very important discussion on how to select markets, and we will go in there today specifically for the bear put spreads that we are discussing. If you need a review on buying calls, buying puts, writing calls, writing puts, please go into the reference materials section. You can go to our demo video, or you can also ask one of our associates to set up an example for you or show you an example where you can ask your own question. So first, let's begin by going to our strategy gallery and look at the particulars of when a person would decide to do a bear put spread. As we have discussed previously, there are two important elements in picking the type of strategy that you will use. The first element is the one that most people think about. They think about direction or directional trading. And in that case, it's really more simple than it's generally made out to be. You're either bullish, think the market's going up, you're bearish, you think the market's going down, or you're undecided. Either you don't know where it's going, but have another reason for being in the trade, or you think the market is going to trade sideways. Now, the other important element that most people don't think about is volatility, which in many ways and for many situations is the only way to really make an informed decision, a specific decision about how to treat direction. So for instance, we can look at volatility, and we do have a program on volatility among our demo videos. We have definitions on our demo sheet, but strictly speaking, volatility is the amount of panic, craziness, up and down bounciness of the market, if you will. And we have discussed the two measures of volatility. One is the historic volatility, and the second is the implied volatility. And you have to really look at the implied volatility and say, is the volatility going to rise? Same as direction, rise, fall, sideways, bullish, bearish, undecided. And actually it's the same thing. Volatility can go up, which means that you expect the market to get more bouncy and crazy. Volatility can go down, which means that you expect a given market to move, but at a slower pace than it has in the past. And finally, volatility undecided, where you either think it's going to be, you're not really sure what it's going to be. And as you can see, there are significant strategies that correspond to how your outlook is. So our trade examples are always built on the premise that we have an opinion both on direction and on volatility in the market. If we don't, then we have to really think about whether or not we are prepared to model out a trade without all of those inputs available. Today, we are going to complete the second strategy. We did bull calls on Tuesday. You can follow that, and you can look at bear put today. The bear put strategy consists of buying a put and selling a put at a lower strike, or there's also buying a call and selling a call at a lower price. Specifically today, we are going to look at a bear put spread, and in this case, we're strictly using puts, not calls. When you use when you go through the strategy gallery and you click on a strategy with a volatility outlook, you're going to go to the specifics of the trade. One of the reasons we designed this software is because charts like this that have been in circulation for years put out by the exchanges and various educators are pretty good explanation. The problem is this image doesn't register with most people on how to do a trade, and it's the type of thing that may prevent people from going forward with their learning. This again is a model that has been out from the exchanges, in this case on bear put spreads, and it gives you the particulars, the long put, which is the put that you buy, with the strike price. You have all those terms defined. The put that you sell with a strike price, and then you see where your profit range is. The much easier way to look at this is going to be, as you're going to see in a minute, and actually inputting real numbers and seeing a real spreadsheet that projects in the money value, profit and loss levels, both on the contract and on the premium. When you, however, look here for a general description, you get the class. It's a directional trade, meaning that the person who does this thinks that the market's going down, and then a narrative of what it means. It means the market is moderately bearish. It's going to go down somewhat, or at least that is more likely to fall than to rise. So this is not an extraordinarily strong opinion. We're looking for a huge move or an explosive move to the downside. This is where you're looking for a downtrending move, a smaller move, a non-explosive move. If you were to think that a market is going to drop explosively rather than in a trending or more moderate, mellow drop, you would not use this strategy. If you think a market's going to drop explosively, then you would go to directional bearish and volatility rising, meaning it's going to go down volatility crazy, not it's going to kind of trend and down in a moderate way. So that's the scenario for these trades. And again, most people don't have moderate opinions, but for those that do, and I think it's good to be a little more moderate than to think that every trade is going to go to the moon or fall to the floor. These types of trades then should be considered. Finally, the profit on this trade is limited to the difference between the strike prices of the options, meaning it's a spread, and again, you're going to understand that better when you see the numbers. It's a limited profit. Your risk parameter is also limited to the premium paid for the spread and the total cost. Actually, it's the total cost of the trade. And here's what a lot of people who bought options really need to know and look at every time they put on a trade, because time decay will often do harm to a trade that is directionally accurate, but does not get the volatility change it was expecting. So in this particular trade, the premium value erodes when the position is at the money or out of the money. So this is a trade in which time decay is against you, but somewhat less against you because it is a spread rather than an outright trade, and you're not expecting volatility to go up. So these are the scenarios for putting on the trade. Again, this is a description of the trade description of the particulars, if you like to see it in words. But what we like to do is we like to look at numbers. So let's begin right now, first and foremost, and look at some examples that will make this much more straightforward. First, I'd like to begin with an example in the stock market on GLD. Somebody has asked us to have a look at some of these strategies. So let me have a look under our. I input these under our master combination calculator. Let me see if I can find it. GLD, excuse me. Okay, 1 second. Excuse me, spread stock option perhaps, just a moment. And there we are. And what we have here is an example on GLD. It's a stock example. It's saved under a tab, which we titled, as we always can. We titled a tab. In this case, it's put spread. And this is for September of 2014. It's a non-margin trade because it's covered. And when I click on the trade, as we now know, because we saved it earlier today, up comes the gold trade. It's very straightforward. When we were looking at it, the stock, the price of the GLDs was at 126.90. and we simulated a trade. In this case, again, it's a bear put spread, and the composition of bear put spread is buying a put at we just randomly selected a price of 13.20. This is again September 14th, so it has goes through the summer and through some of the seasonal stuff that could make gold drop if you think it's going to drop. And again, it's bear put, so those are the examples we have at a premium of 9.20. And as you can see, every time that we select the strike price, a strike price example came up on how to input it in here. And then if you're still at the stage that you would need to review what a strike price means, there's a Learn More box over here on which you can click, and it'll take you to the full definition of strike price. So at any time that you're inputting and modeling a trade, whether it's on the stock options or commodity options or the underlying instrument, everything flows from the calculator here, which is an easy box, to these dialog boxes that give you an explanation of the terminology, instructions how to input the trade, and an additional link to more information about that particular term. So in this case, you can look up strike price, you can look up how to input premium, and again, get more discussion of premium. For a discussion of strike prices and premiums, we do have some videos from former webinars on in, at, and out of the money options. So if you need a refresher on that, you can go ahead and watch those videos. You'll get all the terminology. And again, you can go to our reference materials section. So now let's have a look at the trade. So in this particular trade, we bought a put. Buying a put gives you the right but not the obligation to sell the stock at that price, at $13.20. And you paid $9.20 for that right. When you sell a put, which is the second part of this bear put spread, in this case, you're selling a put at $1,200 for $3.80. So this basically is looking for a move between $13.20 and as close to $1,200 as possible. Again, this is for purposes, we're not saying the market is going down or is going there. We are providing an example of how to calculate a bear put spread. And this is for neutral volatility. And now you get, first of all, you get the dialog box here that gives you all of the bare bones description of the trade. You buy a put, in this case it's a put, that gives you the right to sell at $13.20, and you're spending $920. If you're not expecting the market to drop huge or with rising volatility, which is where a bear put is done, it's for that scenario, you would also sell a put at $1,200, $120 lower, for $380. For 3.8, which is $380, so you are reducing your cost from $920 to $540 if you think the market's not going to drop under $1,200. It's a pretty significant percentage difference between the two. I factored in a transaction cost of 80 here. It can be whatever it is. It's 40 per option in this particular case. Things are charged differently. And as you can see on the trade, your high break-even point on gold would be $13.80. So as long as the market gets below $13.80 on the gold, intrinsically, that's where this trade would become intrinsic or in the money profitable. The second way to measure an option value is not just based on in the money value, which is primarily to be looked at expiration. There's the second way, which is the everyday way of measuring the premium. So because you paid 6.2 in premium, which as we know is $620, you need that spread to be worth more than 6.2, factoring in costs, completely in order to be profitable. So on that particular, on the premium, you check your premiums regularly as you can when you see a big move, as well as seeing where the contract is relative to the market, where the premium is, and you really want to, certainly by expiration, you would want this market to be under $13.80 to be profitable. It could be profitable sooner on a drop with decent volatility, and for that you would keep tracking the premium. The attractiveness of a non-margin bear put spread is in the risk column. because the maximum loss in this particular case would be only $620. So since this is a bearish trade, if gold went up to $2,000 and you sat on your hands and didn't salvage premium, didn't do anything, then the most you can lose textbook is the $620 debit that was your costs and fees. And as you can see, because we're doing this to help people look at what's important, the risk and the maximum loss level is written in bright red, and the profit is in a maximum profit potential is written in the same little dull blue as everything else, because you should not be looking at the second number unless you can live with the first number. You can't live with the risk number. There's no reason to look at the profit potential. In this case, because the spread is pretty wide, the maximum profit, if the market drops to 1,200 or below, at expiration is $11,380 on the initial outlay of $620 for that spread. And then let's have a look, and this is where everything begins to make sense. This is the spreadsheet. Above our entry price at expiration $13.20, if we sit on our hands till expiration of September 14, the loss, no matter how high the market goes, can only be $6.20. On the other hand, at expiration, as you can see, as the price gets lower and lower, if you're at $12.90, already, you're at $23.80, you're at $12.75, picked up $3,880, and so on at various levels, both intrinsically, and again, you also check the premium price. I want to just mention as a general suggestion that when you do a trade like this, if it doesn't start to work within a certain time frame, and you spend $620, and it's a good risk to reward ratio if you're bearish gold, there's no reason to incur the maximum loss. You have a lot of time to this expiration, and if things don't go your way and you're not really happy with your trade and you don't see the market dropping under 1,300 or some level that you expected, then you can salvage premium, and in those cases you might be able to come out with a 50% loss or a 40% loss on this particular option. So you can decide, if this spread isn't making money or it doesn't work by a certain time, I'm going to put in a market order and try to come out with half of what I put in, or whatever your number is, and not sit on your hands to incur the maximum loss. So this is really the maximum loss. There's no reason to take that maximum loss when there's a market that is trading and you have an opportunity to offset. Now, and of course, once you're in here, you can just very easily change the strike prices, change the number of positions. So if you said, wow, I'm really hedging I have a lot of physical gold, or I have a lot of gold stock, and you can measure how much of this you would need in order to cover your risk. You can do two. You can easily change this to two spreads. Just that simple. Everything else stays the same. Again, if you keep you can change the strike prices and how much they cost the same way by using real prices. I'm just going to change from a one option bear put spread to two. It's a simple change once you have the inputs, and as you can see, everything changes accordingly. Now you're spending more, you're collecting more. Your total outlay now is $12.40. Your maximum loss is $12.40, but on a drop, again, if you think it's going to go to $1,200 or lower, obviously you're spending more, you're risking more. Now your maximum risk is $12.40 at expiration, but on that drop you could pick up to $22,760. Again, we're modeling out a pretty big drop based on an example that was provided. On the other hand, the market was first flirting with $12.50 very recently, so it's really depends on your outlook. So now we've seen this example using GLD very quickly changed, and again, if I think this is an interesting trade to hold on to and I want to keep it to follow up, I'm going to save it under tab. I'm going to select the GLD put spreads non-margin for September 14, and I'm going to go ahead and select it. Then I'm going to save the trade, and let's have a look. And there, as you can see, we have the second save trade, a two buying 2 puts at 13.20, selling 2 puts here. We have the premiums, and we have the date that we put the trade in, so that we can follow it up later on if we want to, and see how it's doing. Obviously, if you execute the trade in real time, you're going to have a real-time statement to see values, and we can also set you up with a simulation statement if you are modeling. Now, because we're also beta testing, and this is very important, stocks are pretty simple. When you look at spread stock options, whatever the symbol is, the premiums and the stocks are the same. You do want to factor in dividend yields and such if it's a dividend stock, but by and large, all stocks are very simple, and this is a very robust way of doing calculations on stock and stock options. The part that we're working on now through this beta test, and we're actually very proud of our team and our developers, including Roy, who's on the line, and all the folks, is that we can actually do these calculations on markets that have a variety of tick values, and most people really haven't gotten very familiar with. What we have here now is, let's go ahead and show a bear put spread in gold for August, not September, and this is using the commodity, which is the gold contract, which is a powerful contract. It leverages 100 ounces, which is a fair amount of leverage right there. And again, as in the case of the stocks, what we get is the strategies populated the minute we click on our saved trade. We know that it's a contract with 100 ounces. We know it's got a tick value of 10 cents per tick, which is $10. 10 cents times 100 is $10. So it's 10 cents times 100 ounces. Every penny move is $10. This is on the options. And as you can see, now let's go ahead. We have, if we want to go to the contract specs and all the regular details, you click on the dialog box, and it'll give you all the relevant things that you should follow once you're in the gold market. If you're not familiar with some of these different resources, you should really go through a basic that'll show you how you can go from this additional link to a whole bunch of fundamental information and follow-up information that you need to monitor to be in the gold market. And it's pretty extensive. We developed it with Dow Jones when we were putting out the Megatrends report for many years. So now we're looking at a trade. Now we're at 13.20 to 12.20. This is using the large gold contract. We've paid 54 premium points, and we collect 21 premium points, and let's see how that works. It's buying a gold put at 13.20, which is actually near the money, or at the money, is 54. But remember, 54 times 100 ounces is 5,400. And of course, we're selling one for 21 points, which is 2,100. So that means there's a net debit. This trade is costing $3,300 plus a default commission of 55 round turn. There are 2 positions, so the net cost of being bearish this position, the initial outlay on these numbers, including costs at that rate, would be $34.10. The break even on this using the contract would be at $12.85.90, because this is factoring in the fact that we did pay a premium of $34.10. So the premium is counted as $34.10, which is $34.10 times 100. Again, in red, because you should never, no matter how great something looks or how strongly you believe in something, you should always make sure that you can live the risk. Otherwise, don't even contemplate the reward. In this case, the maximum textbook, sit on your hands, do nothing loss is $34.10. You know, I think when people let a trade go to zero, it's really just lack of serious attention to money. I think you have to be mindful of the cost of the trade, and when you're wrong, you have to get out. Some of you know one of my favorite sayings, he who fights and runs away lives to fight another day. It's not something John Wayne ever said in the movies, But in trading, you can't expect to be right all the time, and if you're wrong, you can cut your losses, and in a case like this is a pretty hefty premium for a pretty hefty return. 65.90 is the maximum profit. It's also limited. So you have to really say, if this trade goes down 30%, 40% in value, in premium value, you have to really think seriously about getting out, because whatever you were thinking initially wasn't correct. And now let's look at the trade. Again, this is where you learn profit and loss. On premium, you keep looking every day as often as you need to make sure that you can sell this option for more than 34.1, which is 3,410. That's where you're profitable. Anything that it's less than that, it means that you're in a minus. For every dollar here that's a minus, you're minus 100. So as you can see here, intrinsically, in addition to monitoring your premium, see when to sell, when to salvage, this is where your trade starts to make money. And again, as we said, starts around 12.85, and then once you get into some of the lower numbers, you hit your maximum gain. Your sweet spot is at its second strike price at the option that you sold at 12.20. So basically, when you put on a trade, when you pick a strike price that you want to sell, you want to sell the strike price that you think is approximately where the market's going to go if it really goes. And this would be a bearish trade. Those would be the parameters. Again, it's a limited risk trade and limited profit potential trade. And if you want to change this trade around again, and you want to say, well, let me see, I want to change this trade. Some people might say, well, let me change this into a ratio bear spread. This is not a non-margin trade now. I'm just showing you this to see how easy it is to make the change. You just buy one, you sell two. This is a ratio put spread. You can quickly calculate the trade, and you'll see how immediately two things happen. Number one, you collect it, you pay 5,400 as before on the long option, 5.54 in premium, but you're collecting 21 on two positions. 21 on two positions, which is 4,200. Now this trade is only 1,200 instead of 5,400 as a debit, much cheaper. Well, that's good. What can be wrong with that? You pay your commissions. Your net outlay then is 1,365. You got a high break even point, a low break even point, and as you can also see, the risk has just become, this has just become a margin trade. So what makes a put spread a non-margin trade is if you never sell more options than you bought. By selling more than you bought, obviously you're collecting more money. Your premium break-even point is much lower. You're talking here about a very low premium break-even on the premium, and your maximum profit potential again has picked up because you paid less in the beginning. Now, as you can see, this is where the range of a trade is so important to anticipate. A person, you start making money sooner than the previous trade on a smaller drop. In fact, at 1304, you're already up 235 intrinsically, in addition to monitoring the price. So you're profitable sooner, you make more money closer in. So at 1220 you make more than you would have made before. At 1230, 32, 44, you're still making more than you would have made on the other spread. Your cost is less, so your losses are less if the market goes up big, but because it's a margin trade, once you get under that 1120, you have a margin of error because you got a deep spread, but on a huge drop, let's say if the market gets to 1120, you start giving back that money and having a naked options, your losses increase and increase. So one should never consider writing an extra option and getting naked if they cannot look at these numbers, either because they think the market's going to drop that much, or because it's inconceivable to take that kind of a risk. Then you don't do this thing, you don't sell the extra option, and you stick with your bear put spread. So as you can see, the software makes it very easy. If you make a mistake and you want to do a non-margin trade, but you input an extra position, you get the nice red alert right over here that tells you you're in a margin trade, and then you can actually see over here what is the impact of that margin and at what levels. And again, for some people, this might be perfectly good. They might say, you know what, I don't think the market's going that far down. If I got a cushion down to 1160, 1150, even make money at 1136, you know, and have a range, let's say from 1304 to 1136 for this trade to make money, if somebody feels that that's the range where this market will end up, then this trade would make sense. Again, it would only make sense for this range, which is where we're looking at the happy green color, if you can swallow the risk of this thing in case the market breaks down. And if you ever thought that it will, you don't do the trade. So in this particular case, although the trade is being saved over here under current trades with a date, I'm not going to save it under the tab because this is for non-margin trades. Remember, if you want to email this trade, and again, I want to thank our beta group for helping us come up with these tabs. Number one, terrific idea, email to a friend. If you have a trading partner or somebody you talk to or that you're learning with, which always makes it more fun, if you think this is an interesting trade, you can email it to them. You can also save it, as we said, under a tab. You can post it to a forum if you want to get other people to tell you what they think. You can also go to the forum to see what other people are doing so that you can test out different trades and exchange opinions with people. And finally, some people still like to look at a piece of paper. You can print this out and scribble on that on the notes and write out whatever you need to write out. And for myself, I sometimes do print out trades. If you want to compare a trade very quickly, as you can see, it's very easy to quickly skip back and forth between different trades. So here we have the 1 by 2. We can look at the profit and loss box and have a quick look at the spreadsheet. Then, you know, we can go back. Let me go look back at the 1 by 1 trade, which is non-margin. Again, you have a quick summary box here. You can see the risk. You can see the numbers. And then you can go straight down to the whole spreadsheet. You can click back and forth. Or again, if you like to actually stick them side by side, you can print them out. You can put them next to a chart so that if you see a gold chart, you can see how these expectations fit in with what you're going to be doing. And let's go ahead now and move on to the next example. By the way, because this is not individual advice, it's really modeling. As you can see, we just gave an example on a bearish gold trade. Last time we did a bull call spread, which is the opposite of this trade, also using gold, also using soybeans, and also using the S&P. So we did examples of bull call spreads previously on the same markets, and now we're showing the examples on the bear put spreads so that we stay consistent with our examples. And as you can see, they can operate regardless of opinion. You just have to have an opinion, and then whether it's long or short, these are the long and short with undecided volatility trades. Now we are next to a market, the soybean market, which has generated a lot of excitement because of weather and demand and all kinds of factors that are taking place. And let me go ahead and pull up the soybean trade. Please bear in mind that when you do these types of transactions, you have to just a moment. Okay, everything is input. Excellent. Okay, as you see, the minute that we pull up the saved trade, the contract specs again and the dialog and help boxes appear here, which is so we got 5,000 bushels. All the calculations are in. You don't have to multiply. You don't have to divide. On stocks, again, it's simple. Everything's 100 shares here. We've got 5,000 bushels. We have strike price examples, and let's go ahead and see how this trade pans out. This is buying a 1320 put and selling a 1220 put. This is on the July soybean contract, and as long as there's one covering put for every sold put, this is a non-margin trade. You can see that in our strategy gallery, and you can see it in the quick review box here. So we have the specifics of the trade, the costs and premium, and then what really matters, which is the bottom line, is that on this particular transaction, the purchase of an option is $24.50. The cost of it is reduced by $750 by selling an option at a strike where this particular person would be saying, I don't think the market's going under 12.20 or much under 12.20. So you would sell that basically to reduce your cost here, and again, now you get the numbers factoring in commission and all your fees, whatever they may be. That's a flexible number in the input box, so you can input what you actually pay. And again, here, as you can see, we have a break even on the futures, which is a 1283.80 at expiration. So you would want to see the market take a drop in towards that area, and preferably sooner rather than later. And for day-to-day monitoring, using all of the changing volatilities and up-to-date prices, this is your premium break-even point. Your maximum loss, again, is limited. Your maximum loss on this trade would be limited to $18.10, which would be the total cost paid for the trade. The maximum profit is also limited to the amount of the spread minus the costs. So the profit is the difference between the two strike prices, and then you have to also factor in that you do have to pay your costs before you're making profits. So in this particular case, on break-even, it would be on premium would be 36.2. You should monitor those very regularly, along with the price of the contract. And again, when we look at intrinsic value, which is an objective measure, you see where this trade would make money, where it would lose money, and again, I would be very mindful that if we don't see the market dropping underneath that futures price or see that premium appreciate, in my opinion, when somebody spends $1,800 in premium on a trade, on speculation, and they have a significant amount of time, you have to have a plan for an exit strategy. So that's something we're going to follow up in future webinars, and monitoring existing trades and saved trades. There are multiple ways of doing this. One way is to set an alert on the futures, and when that price is triggered, where you no longer hold the opinion that you are bearish, or you set a price on the stock if it's a stock, whatever the instrument, when that price is triggered, you salvage premium, whatever that may be. Or you can use a premium break-even. So in this particular case, if your premium break-even is 36.20, if your premium break-even, yes, this is 36.20, okay, then you have to just one moment, let me have a quick look here. 17. Okay, your maximum your maximum risk is 18.10. Excuse me. So if your maximum risk is 18.10, you want to have a break-even premium level, let's say, where you can say I'm going to risk $900. And if this premium, when I get a bid and ask, is down to $900, I lost $910. You put in a market order, which doesn't guarantee a fill, but you'll get out, and you say that's when I put in a market order and I'm going to get out. You can also use limit orders, which don't guarantee an exit, and you can go into the type of orders questions that you may have. We have glossaries and information on all of that. That's very self-explanatory, and we are going to do a program on how to place orders and the different types of orders that are available, such as stop orders and limit orders when you do these. But in principle, just again, as you model out a trade, if you spend $1,800 on a transaction that has time, don't cross your fingers and wait for zero. Have an exit strategy if it's not working, and also have an exit strategy if it is working. So let's go ahead now and proceed with our final example of the afternoon. And a lot of people are very intrigued by what's going on in the stock market. So we have actually put together we also are indicating a trade here on the S&P 500 index. This is a large contract, the S&P 500 index. Just a moment. You click on it, and then again, you see all of the dialog boxes here in the corner change so that you can look at the contract specs. You can go to a detailed page about the S&P and what to monitor on the S&P, as well as review the definitions of strike prices and premium. And here, this particular trade, which is on the S&P 500 index for June, these are June options, from 1830 to 1730. These are the premiums paid. And again, you can see the premium description of how much the points are and how premium works. It's just another click away. And let's have a look at the trade. It's $250 a point, so it's 57 times 250 is 14,250, and 28, which is the option that we sell, is 7,000, reducing the cost of this trade to 7,250, but also capping the profit potential at 1730. So if it drops under 1730, your trade is maxed out. You're not going to make more. So you're looking for the market to end up as close to 730 as possible, and preferably at 1730 or below. If that's your outlook, this is your trade. If it's not your outlook, you have to change the strike price or you have to change the position type. But again, it's the way a bear put spread works. Again, as you can see, you have a limited risk, but it's a pretty hefty risk of 73.60 for one position. But you have a profit potential that's larger. It's almost 2.5 size, 250%. That's 1730, which is 17,640. It's an expensive option, so you have to keep monitoring the premium that you paid. You have to really capture back your 29.44 points or more to make money in premium. And then intrinsically, as you can see, you really need this price to find its way under, again, the futures break even of 1800.56. And then as you can see, once you get under that number, the gains pick up pretty fast. At 1750 doesn't feel like that long ago when we were there. In fact, it feels like a few weeks. But on a drop back to that level in this time frame, let's say the market gets to 1754, which is we scale the numbers according to the contract size. On a drop to 1754, intrinsically, this position would be worth 11,640. You'd have to check the premium separately and on. Once you drop under 1730, as you can see, you've really maxed out, and any further drop is really not going to benefit your position intrinsically. But again, you can check your premium to see where that is day to day. Especially for somebody who does a trade like this, I can't impress upon you enough that in order to catch winners once in a while like this, you have to make sure that you preserve your equity, and if the market doesn't go your way, that you do not sit on your hands and wait for these options, which are options that are expiring, that are through June, that if this market doesn't go your way during February, during the remainder of March, during April, there's a time when you're just going to have to say, I'm not going to leave all this money on the table. I'm going to fight and run away. Again, he who fights and runs away lives to fight another day. Salvaging a few $1,000s here on a losing trade might enable you to get into a trade that's going to win instead of just chasing something. So you have to be proactive, and you have to monitor markets. For your information, there's also, speaking of the S&P contract, there's also, and I'm just going to go ahead and show you, just because the instrument, there are so many instruments today, they're great instruments. We also have a lot of mini contracts for futures traders and people who want to take smaller risks. So on the mini S&P 500, E-mini S&P, we can input that contract. Now you see that the contract specs changes. Instead of $250 a tick, this is a $50 tick. So instead of leveraging about 450,000, you're leveraging closer to around 100. So let's see, 50 times the index, so we'll call it 1,800. And let's see, let's pick the strategy again. We're going to go to a put spread. Okay, we're going to input a cost. Hold on a second. I'm just going to input a cost. As you can see, this is pretty easy. And then I'm going to go ahead and put in the trade and make sure that I'm using the same strike prices. I'll go back to the same save trade over here. So I'm going to buy one, sell one. I put those in right away because if you sell more, it's a margin trade. And if we do it by mistake, it's going to show here as a margin trade in red. So that's very important in terms of knowing what kind of risk you're taking. I'm call it the 1830 put again. It's all the same. It's just a smaller contract. Let's sell the 1730 put over here, so it's the same. We're going to pay 57 points. Hold on a moment. We're going to pay, excuse me, we're going to pay 57 points here. Again, I'm copying right off the tab. It's just a different contract size. You're going to sell the 28. Again, I'm copying it off the tab. Okay, this looks okay. If I mess something up, it's going to give me an error message. So then we just hit the calculate button, and there we are. Now, one thing happens. The minute we hit the calculate button, this here pops up under current trade. So we can look at them, click on them back and forth like we did before to compare. This is the large contract, risk, reward, cost, and so on, which we just did. Oh, excuse me. I just went to the wrong position. Oops. Good thing is that it all pops up and you see it. So if you do something quickly, you're rushed and you're not thinking, which I just was, you see immediately it's the wrong trade, it's the wrong ticks, it's a 1x2, it's not the right thing. Immediately you say, wait a minute, let me go back to the to this trade. Okay, and now we are to our trade, and now the risk is significantly. Make sure I've got the, yeah, there it is, the E-mini S&P put spread, all the particulars are the same, and let's see what happens. Now, instead of risking 73.60 on the trade, maximum risk, our maximum risk goes to 15.60. So you can literally click back and forth, compare the maximum risk number. Let's see what's the maximum profit here. On the large contract, the maximum profit is 17,640. On the small contract, it's 3440. So you can literally click back and forth and decide which one is more within your budget. And then if this trade looks right for you, you can save it under a tab and bring it over here to keep following. If not, you can just delete it. So let's have a look at it here, and it's a different trade now. On the same spread, again, the S&P can fly to the moon. This is a bearish trade. The maximum loss, if you don't salvage a penny and you sit on your hands, watch things erode, is 15.60. That's your maximum textbook loss. Incurring the maximum textbook loss is really, just because that's possible, it's not really a great idea. So you should monitor values and not go to sleep when your money's in the market. As you can see here now, the gains are less than on the previous position, but if you get under 1800, certainly once you get into the 1790s and below, this trade intrinsically starts making money. And the place where your profitability stops is at the strike price that you sold at 1730. You turned over the profit potential to the person who bought that option from you. So no matter how far it drops below that, you just get your 34.40 max. Before that, you check your premiums. And again, on a rally, if you sit on your hands till expiration, that's your maximum loss. And as you can see here, you can take how strong your opinion is, and you can take the size of your budget and compare bear puts even within the same market using different instruments. So today we've seen in the case of the S&P that you can use a large contract or you can use an E-mini contract. We've seen in the case of gold that you can use GLD or you can use the gold 100 troy ounce contract. And again, for futures purposes, there's also a 1/3 contract, a kilo contract in gold, and the micro, which is a 10-ounce contract. I think for people who want to trade futures with some staying power and less leverage, the 10-ounce contract is a very interesting instrument, and you can always model out trades on that using a simple tick-by-tick calculation. So I want to again thank the people that helped us come up with these new tabs, the email to a friend tab, the print tab, which is very important. I know I like to print things, as well as the idea of forums, and of course the Save Under tab, so that people can organize their trades. With this particular presentation, unless there are any further questions, we've completed the section on bull call spreads and bear put spreads. These are twin trades. It's just that they both have a, I don't know where the volatility is going outlook, but one is for markets going up and one is for markets going down. And as you can see, the simplicity of calculating the premium and actually seeing the profit and loss figures on the spreadsheet give you a clear idea without confusing yourself about what's a put, what's buying a put, what's writing a put. These are things you should know. But you can do the math, and I think seeing the math wires the brain to understand and know better. Does anybody have a question for me?
There were several questions that you actually answered in the course of, but we do have one. Do you recommend deciding how much money you are going to risk on a trade when you first put it on, or deciding after the trade goes against you for a while?
Well, the first thing to do is there's an old saying, and I'm a very big believer in folk wisdom, because it carries across to all concepts. So there's a saying, he who fails to plan plans to fail. One of the things that we're going to be showing as we move through this program, and we're trying to do the educational and trading speculation in an orderly fashion, so that we can wire our brains in the right sequence and don't get ahead of ourselves and confuse things. It is very important when you put a trade on. Let me use one of these examples, if I may. So let's look at this bear put spread on the S&P. And a lot depends on why you are putting on a trade. If somebody has a stock portfolio and they're putting on this trade in order to hedge their risk in case the market drops, so that the hit they take on their stocks is reduced. So this is really a hedge trade. This is kind of like an insurance risk reduction trade. Your exit strategy is very different. You might hold on this whole thing, hold on to this whole thing on a full drop, because it's, you know, what you're making here you're losing somewhere else, but at least you're not ending up in the hole. So that's a different plan for somebody who's hedging or thinking of reducing the fear they have about their stock portfolio. And a person like that might also not need to offset this trade if the stock market goes up strongly, because what they are losing here, which was kind of as a hedge, they are more than making up on the other side. So in a case like that, it's really a function of what is an individual's financial objective and what is the purpose of the trade. If somebody is strictly speculating on this, and you have to know, you have to have a reason for doing a trade. If you're not sure why you're doing it, maybe you shouldn't do it. But let's say, so one reason that we've reviewed, which has one set of decision-making parameters, is, are you hedging? Are you trying to reduce your risk, or is this part of a bigger strategy? And that's why I like to know where people are as much as possible before, you know, certainly before giving any specific trading advice or setting parameters. People have to know what their motivation is. If somebody's strictly speculating, that is, they say, I'm just going to bet that I think the stock market's going down, and there's nothing else correlated to it, the trade has nothing to do with anything else, then I would do one of two things. Number one, I would set my exit based on why I got in and what I thought. So let's say somebody says, and this is a very valid way of phrasing an opinion, somebody says, you know, I'm looking at the S&P, and I think it's going to really, really drop. But if it doesn't drop by March 30th, and it's at such and such a price, it's not going down anymore. It's just going to stay bullish and have a summer rally. Again, I'm not saying that's true. I'm just saying that this is a set of thoughts that a trader should have when putting in a trade. Then they should say, okay, I'm going to, if I'm not in profits by such and such a date, I'm coming out. And they might be in a trade where they're going to come out at a break-even. Or they might come out at a small gain or a small loss, or maybe a larger gain or a larger loss, but that's one parameter. Another is to say, I just spent, in this particular case, would be 73.60 on a trade. The minute that premium drops enough that it's worth 50, for example, so I lost 23 points times, so let's say somebody's down 20 points. I'm going to risk 20 points on a large contract, or I'm going to risk 10 points. Let's say somebody says I'm going to risk 10 points, which is $2,500. And you have the tick value up here that you can look at. And then somebody says the minute that trade is down and I'm down $2,500 on this trade, I don't care what happens, I'm getting out. I was wrong. There's nothing wrong with that kind of a discipline. Or you can say if the futures breaks out above a certain level and you have a technical, let's say, a level of, let's say, 1860 or 1850, whatever that may be. If you have a level in your mind that you think is going to hold and it doesn't, then you immediately revisit this position and think of getting out. Because the easiest thing to do is to get out of a position, and if something else looks good, or if it looks good the next day, you get in, but you don't want to be in the habit of sitting around and watching a position erode and lose money until it goes to zero. Once in a blue moon, a losing position like that may turn around. But generally, if it goes the wrong way and sustains the wrong way, especially when you have a big premium like this, and as I said, time erosion is against you. So if you're in a trade also where you are fighting time erosion and it's not going your way with the right volatility, you come out early, either with a futures preset level, a date level, if you are looking for a certain event to trigger the market, or based on an actual dollar amount that is your risk parameter on a trade. When that level is triggered, or something, or the market gets near that, you get an alert, and then you make a decision on offsetting with a market order, with a limit order, whatever the circumstances allow. So I would certainly put on this trade, and I would not put on this trade without at least having something in place about when to come out. In fact, wise and sensible stock traders and futures traders, forex traders, you name it, will hardly ever put on a position without immediately instituting a stop or an exit strategy. And you can always replace that strategy. You can do a cancel replace, you can do an open order, you can set up a contingent order, but always, always, it is very important that you not put something into the market without a very specific initial idea, at least, of how you're going to get out. And in my opinion, for purposes of strong discipline, to actually put on your exiting trade immediately. And then if you really change your mind, and opinions vary about whether or not you should adjust your exit once it's in, but at least I would have it in there, and then if you later change your mind and you think you have a good basis for it, you can always change the order. There's no charge. It won't cost you anything anywhere to change your stop or to change a limit order that you have in the market. And in many cases, if you have a trade, for example, a profitable trade, you will want to look at things like trailing a stop or adjusting your alerts to follow your trade, and eventually to raise your exit levels and your objectives in accordance with the movement in your position. And again, that's something that we can easily do because we'll have all these trades saved here and modeled out with premiums, with costs, with dates, and you're also going to be able to save those trades in a real-time updated platform that we're going to make available to our beta group in a couple of weeks, where trades are going to be saved and updated, and you'll be able to see updated values in real time very quickly. That's going to be the next stage, and we're looking forward to starting that no later than March 15th, but in all likelihood much sooner. So yes, you should have an exit strategy, and you should know what that exit strategy is before you even get in the door. Any other questions?
No, we're good.
Okay, well, I want to congratulate everybody who's sticking with this. Please, if you see anything in the software that you would suggest, if there's anything that you like about the programming, if it's helpful, please let us know. We love positive feedback, but what we love even more is suggestions on how we can make this better for you, how we can improve it. I'm very pleased about the suggestions we've had about the email feature, the forum feature. We added them right away. I'm really glad of the tab feature, which helps us organize trades, and hopefully we will continue getting real good feedback so that this is a useful exercise for everybody. It's a useful exercise for the participants, and it's a useful exercise for us. And we're all really trying hard to make this a tool for education and to better understand the risks and rewards of trading, so that you can be more flexible, in your decisions, and perhaps do some things, if they are suitable for you, that you would never have known how to do or how to calculate. So I hope we're heading in the right direction. Please answer your surveys and keep us posted on your feelings and opinions. Thanks again. Have a super afternoon, and we're going to the Hot Markets program tomorrow, and I can give you a preview. It's going to be on the S&P and the volatility index. The VIX is a very powerful tool, and we'll probably, depending on the overnight action, either be looking at metals or at crude oil as well. So again, thanks for participating, and keep focused on improving as traders. You have our support. Have a great afternoon.